Hi, welcome to Introduction to Futures and Options. I'm Doug Carroll. We're going to spend some time introducing derivatives in general to give you a sense of the common features of derivatives and how they differ from other sorts of financial instruments, but then rapidly segue into a detailed discussion, first of futures contracts and ultimately of options contracts. And we'll identify the key characteristics, contract features, a little bit about their pricing, and applications and risk management and hedging. So let's go into the subject. So first off, a little bit on derivatives. And one of the important things to realize is despite the huge variation in different types of derivative contracts, if you boil it down to their bare essentials, there's really only two types of derivatives. Oh yeah, many variations, but ultimately, when you boil it down to basic conditions, really only two types of contracts. And those two broad types of contracts, as are indicated on the diagram here, are forward commitment contracts and contingent claims. Now, in the forward commitment contracts, and the key word there is commitment, two broad categories, one being futures and forwards. You might say, wait a minute, that's two, futures and forwards. No, they're really the same sort of financial instrument, because what are the most common definitions of the two? Well, the most common definition of futures is they're exchange-traded forwards. Forward contracts, they're usually defined as over-the-counter futures contracts. The circularity of those definitions are not very enlightening, but they speak to the fact that they're basically the same thing. Oh, there are differences, as we'll see over the course of the discussion today, but in brief, the differences are in terms of how the contract is created, who becomes the legal counterparty after the contract is created, and then how you manage the risk between those two counterparties. In those details, futures and forwards differ. But if you look at the substance, the general pricing models, the risk management applications, speculative applications, futures and forwards are exactly the same thing. And the other broad category of forward commitment contracts is swaps, although it's swaps except CDS, credit default swaps. Because despite the fact that swap is in the name of all swaps, the other types, the forward commitment swaps, equity, currency, commodity, and interest rate, they're really packages of futures or forward contracts. As opposed to CDS, credit default swaps, they're, well, in the other category. And why did I say the emphasis here is on commitment? Well, because both parties to all of those forward commitment contracts have made a commitment, i.e. have entered into a contract where they have a legal obligation to do something. Now, in an interest rate swap, which we're not going to talk about today, but just to give you the commonalities of these things, in the most basic form of a plain vanilla interest rate swap, one party is committing to pay a floating interest rate, the other party is committing to pay a fixed interest rate. Now, the futures contracts, and they're similar to forwards anyway, but we're going to talk about futures in detail today. And for futures and forwards, where there's a physical delivery feature, the short, or the seller, has obligated to make delivery. The long has the obligation to take delivery. Now, why am I focusing on this commitment? Well, if parties are exchanging obligations, and if they exchange them at fair value, what's referred to as an at-market contract, well, if two parties have exchanged equal but opposite obligations, who has the advantage? Well, of course, neither party has an advantage. Now, this might sound obscure, but if neither party has an advantage, guess what the initial value of such contracts are? Well, the initial value of such contracts is zero. You may say, oh, it's theoretical curiosity. Oh, it's more than that. Because think about it. If you can get into one of these positions at no cost whatsoever, that's extremely capital efficient. Oh yeah, you might have to put up some assets to, it might be called a margin in the futures market, or it might be called collateral in the over-the-counter derivatives market, but that's still your money. You're just putting up something that indicates your willingness and ability to live up to your financial obligations. But think of the capital efficiency to be able to take a position for risk management or speculative purposes where you might only have to put up assets equal to 2 or 3 or 5% of the total value of the position. And that's, in general, one of the big attractions of derivatives is their capital efficiency. One could establish an exposure, which I'll define in more detail later, with putting up assets that represent a very small value of the overall position. Now, the other sort of derivative that we'll talk about specifically about options, but options are a subcategory of this other type of derivative contract known as contingent claims. Contingent claims? Well, think of a basic option contract, which we'll define in great detail later, but I suspect many of you had at least a little exposure to options previously. So it goes on in a basic option contract. Well, the buyer of the option acquires the right to do something, right to buy if it's a call, right to sell if it's a put, and again, we'll talk about that in great detail later. But the seller of the option incurs an obligation to fulfill the contract. In other words, grant to the owner of the option the right to do whatever they have the right to do. So if the owner of a call has the right to buy the underlying asset, the writer of the call has the obligation to sell the underlying asset. But note the extreme difference in the contractual relationship between the buyer and seller, the long and the short, on a contingent claim versus a forward commitment contract. Again, in the forward commitment contracts, parties are exchanging equal but opposite obligations. And if done at fair value, neither party has an advantage. So forward commitment contracts, if done at market, and the vast majority of them are, have that zero initial value. And again, that's the capital efficiency I talked about before. But with options, it's an inherently unequal contractual situation. The long acquires the right to do something. The short incurs an obligation to do something. Clearly, that's inherently an unequal contractual situation. Well, of course, that's why the buyer of the option has to pay the seller of the option something, what's called a premium, to compensate the seller for the risk they're taking on. So no matter how short the time to expiration and no matter how far out of the money, an option should still be worth something, because even with only a short time left, the market could make a very large move, making that option all of a sudden worth a lot. So options will always have a cost. Contingent claims, again, forward commitment contracts, again, usually done at market, are going to have no cost whatsoever. And having that basic insight into the extreme differences between forward commitment contracts and contingent claims, or the variations of each we're going to talk about today, futures and options, if you have that grasp of that basic difference, that's a good step in the right direction to understand their pricing and valuation. Now, here you see an overview of the gain-loss profiles, and I won't linger on them here because we'll talk about them in some detail later, and we'll actually develop a few of them. But this is a common graphical frame of reference that people in the derivatives business use to understand their exposure. Now, I've used that word before, so let me define it in a little bit of detail here. So the word I used was exposure, and one way of describing these diagrams is to say they're exposure profiles. Exposure used in that sense simply means that you have a position in the market. Oh, maybe it's fully paid for, or maybe it's highly leveraged. We'll talk about that later. But you have a position in the market, and to the extent the market moves in your favor, you're going to generate a gain. Market moves against you, you generate a loss. All right, so that's all exposure means. Well, these are the exposure profiles. And you'll note that the four corners show the four basic option positions: long calls, long puts, and short puts. The two in the middle of the two columns show the gain-loss profiles, or the exposure profiles for, well, you'll note how these are labeled. On the left-hand diagram in the middle panel, you'll note that's the exposure profile of a long underlying or long futures position. And the other side, it shows short underlying, short futures position. Now, first, to explain what you're looking at in general, we're measuring gain or loss by vertical displacement from this line in the middle on the vertical axis. And the horizontal axis represents the price of either the underlying asset or the derivative contract itself. And you'll note if you have a long position and you go long at some price, say at that price, and the market goes up by 2 points, well, you're going to generate a 2-point gain. On the other hand, if the market, after you're going long, drops by 5 points, well, you're going to have a 5-point loss. So you'll note you have a symmetric gain-loss profile, increasing gains in a rising market, increasing losses in a falling market, if you're long either the futures or the underlying. Short gives you exactly the opposite gain-loss profile, increasing losses in a rising price environment, increasing gains, that's again increasing losses, I should say, in a rising price environment, increasing gains in a falling price environment. So that's again that symmetric gain-loss profile. And you might wonder, well, why do you need a futures contract to do exactly the same thing as you could do by going long or short the underlying? Oh, well, remember the capital efficiency I talked about before. You can take a position in futures, oftentimes for putting up assets with value as little as maybe 2 or 5% of the total value of the position, as opposed to going long the underlying, which you have to pay for in full, either with money you've saved up or accumulated, or convince someone to lend you the full value. Well, note, it's oftentimes a lot easier to get more leverage in the futures or the derivatives more generally than by trading the underlying. And we'll not go into it in great detail now, but note the dramatic difference of the look for the option gain-loss profiles versus where you're long or short the underlying or the futures contract. Where forward commitment derivatives, futures and the swaps I identified before, and underlying asset positions, whether long or short, generate symmetric gain-loss profiles, increasing gain if the market moves in your favor, increasing loss if the market moves against you. You'll note options give you asymmetric gain-loss profiles that show limited gain or loss as the contract moves out of the money, but increasing gains or losses as the market moves in the money. And I said either or because it depends on whether you're long or short and which way the market's moving. But again, we'll talk about these diagrams in great detail in context a little bit later on.